This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Ben Griffiths, thanks very much for coming back on Talk Your Book. Really appreciate you taking the time and sitting down for a chat.
Great to be back, Chris.
Now, I think last time I spoke to you was just during that March sort of meltdown period, and it was great to have someone with your experience and calmness around to chat through that time. I guess, why don't you start by telling us how Eli Griffiths has been able to withstand the markets and perform this year?
Yeah, well, I will say I have seen a few markets, ups and downs, highs and lows. This year's market has been simply extraordinary. It's been surreal in terms of what it's done. You're right, we had a great discussion back in March, Chris, and we talked about what does one do in times of crisis. And I remember we talked about no two crises are the same, but the playbooks are identical. And we talked extensively about, you grilled me on Auckland International Airports and how that measured up. And of course, that stock has been a bit of a star emerging from the ashes of that market meltdown in March. Look, we've gone okay. We've had a good year. I'll admit we went into the sell-off in February into March with a larger than normal allocation to cash out of basically precaution for what lay ahead with COVID. And we had to quickly rotate and get ourselves back invested. The small caps, if you do a measurement from that March 23 low point through to the end of September, small caps have actually rallied about 50% from that low point. I'm happy to say that Eli Griffiths Group, our small cap fund, having been momentarily bumped off momentum in that early stages because we had too much cash, was able to get invested quickly and finish the September period broadly in line with that market advance, up about 50% from the lows. I was thrilled that we were able to do that, and full praise goes to our team being able to react and get invested. I'm even more excited about our emerging companies fund that also got swept in the downdraft lower and finished September up about 62% from that low. So it outpaced both the small cap fund and of course the benchmark. So it's been a year, Chris, very much of recovery from a distressed sell-off. It's been a year of staying fully invested, staying focused, and having respect, as you always need to have, for the power of liquidity, whether it's central bank generated liquidity, or whether it's, as it turns out, it's government-sponsored safety nets, which has, of course, put a nice floor under most Western economies, including our own. So it's been a year of learning. It's been a surreal year, but it's been a very strong year for equities, and you've needed to be fully invested.
And how are you feeling about the next 6 to 12 months?
I feel pretty good. I'm on the record as saying I wasn't fussed whether the Republicans got up or the Democrats. My view was there was so much liquidity in the system. The system is charged. We've had an earnings funk this year through this COVID-inspired disruption to global economies. My belief is that the liquidity and the cash that's in private check accounts and savings accounts, corporate bank accounts, all it's missing right now is a genuine revival in consumer confidence, which will happen when the governments of the world are able to basically check the spread of COVID-19. Once that happens, I believe animal spirits, consumer confidence and business confidence will reassert itself. I think that's rather close to hand. I think it's sooner than you think. And I think that will spark a consumer revival, which will then spark a business investment revival fueled by the copious amounts of liquidity. So I feel pretty good about the outlook for economies internationally and stock markets as an outworking. So I think 21 is going to be a good year for equities.
And what stock do you want to dive into today?
Look, I thought we'd have a bit of a chat about a stock that not a lot of the listeners will necessarily think that will associate me with, and that's Lioness. And Lioness is it's a rare earths miner and producer that's had certainly a controversial history. Things haven't been so great for Lioness, but it's had a volatile history too. So, Chris, I thought we might take some time to have a chat about Lioness.
Sounds good. So we'll dig into Linus specifically in a second. Why don't you start with maybe the helicopter view of the rare earths industry and what that looks like from your perspective?
Yeah, sure. Well, rare earths have that sort of misnomer tag, rare earths. Actual rare earths themselves are reasonably abundant and plentiful. But where they're rare, of course, is the way in which they occur. They don't tend to occur in commercial deposits or mineable deposits, and hence they have the moniker of rare earths. And I guess what are they used for? There's 13 different elements within the stable, and they're used for a variety of applications, essentially in electronics, more or less. You'll see them featuring in robotics and drone technology, but most critically, of course, they're used in the manufacture of permanent magnets, and these are in motors and generators, and they will be a pivotal input, and I mean pivotal, to the production of electric vehicles, electric vehicle drivetrains, and also in renewable energy applications as far as wind power goes, for instance. If you look at a typical hybrid car, you'll look at that and you can walk around and you can look at the components that will have, in some shape or form, be made up of a rare earth. It probably will be what they call NdPr, neodymium praseodymium. NdPr is a bit easier for us to talk to.
Yeah, I'm not courageous enough to have a crack at the actual terminology, Ben. I was definitely going to stick with NdPr.
It took me a while to get on top of it, but I thought I'd at least mention it once in our chat. Everything from headlight glass to windscreen glass to motor applications within the actual drivetrain of the motor vehicle, various electronics throughout the car. So they have an important use in EVs and in the cars, as I said, today that we drive around. So they're in pretty solid demand. And I guess the crux is that 90% of the world's supply of these important elements, of course, come from China. And so I think Lioness can lay the claim to being the world's largest non-Chinese creditable supplier, in fact, miner, separator, producer, distributor, and marketer of rare earth materials. An extraordinary claim. And Lioness sits strategically in a great position.
And you mentioned Linus had an interesting history. Maybe before we get into what's happening today, maybe walk us through what that history looks like and how you view that in how it could affect the future.
Yeah, well, as you know, I'm a bit of an old warhorse. I've seen so many of our listed companies either not make it, but in some cases I've seen exceptional stories where Australian listed companies with so-so prospects, nothing special, actually happen upon something that's quite meaningful, either by accident or design, exploit it, develop it, and become major success stories. And the Lioness story goes right back to the 80s when they were a fledgling gold miner without a huge amount of prospectivity. And Les Emery was the CEO, who I'd met on several occasions at the time. He was determined to build a gold mining operation, but meanwhile had been shown this deposit on the Mount Weld cattle station, which is, of course, where the deposit sits. It was actually owned by Ashton Mining and Anaconda, and they were more than happy to progressively sell that interest to Lioness. And so Lioness decided that rare earths were probably something they should be involved in, no matter that the ultimate market for rare earths was not going to become anything until the 2020s. So we're back in the 80s here, back in incredible luck or foresight, call it what you like. And so over time, we saw Lioness shed its gold mining operations and focus purely on developing Mount Weld as a foremost supplier of rare earths. You know, when I was looking at a chart, Chris, and it's extraordinary. You have a look at what the Lioness share price has done, and clearly that's an outworking of what rare earths have done, the price-wise. And we had an extraordinary boom in rare earths pricing in mid-2010, 2011, where rare earths NdPr, we'll talk to, was about $25 a kilo. The Chinese announced that they were abolishing export quotas, and NdPr went to over $250 a kilo within a 6-month period, which then brought about a surge of interest in Lioness before things came crashing back down to earth. when export quotas from China were granted. And then we get into the murky history, which I'm sure you're going to tease me out on, the murky history on Malaysia and what they did there. But the point I'm going to make here is that, Chris, most major successful frontier companies or frontier industries had their beginnings in a speculative blow-off and then a cataclysmic collapse. And if I look back as far as the October 1929 crash, and from the embers and relics of that miserable period, the stock market history, we had Standard Oil, we had US Steel, and we had Home State Mining born from the ruins. And each of these corporations went on to become extraordinarily large and successful. The same thing happened in the dot-com era, where we had a flurry of speculative interest that blew the market sky high in late 1999, early 2000. And of course, then it came back down to earth with the giant meltdown. But from those ashes and from the ruins emerged Amazon and Apple and Microsoft. These businesses today are the leaders, clear industrial leaders of the modern world. I'm going to make the case today that with Lioness, we've seen the speculative blow off when Lioness share price got to almost $27, Chris, and then by 2018 was 32 cents and unloved. You mentioned Westfarmers, and we'll touch on Westfarmers also spotting a great opportunity last year, but we'll get to that later. So that's the opportunity. It's a business that was born of a major speculative explosion and then a tragic implosion, and the seeds were sown, we think, for Lioness's future.
And so why don't you talk us through Malaysia, because that'll be a bit of a stumbling block for some investors. It's been a bit of a shit sandwich, to use a technical term. Talk us through what's happened in Malaysia and where they're currently at with that part of their business.
Yeah, well, Malaysia, of course, has been difficult for the company, and I should say, Lioness shareholders should be grateful that we have a professional like Amanda Lacaze at the helm, who's pretty well been there as CEO since 2014. So she has had to go through all the planning and approvals processes to have a plant built in Malaysia to crack and leach the rare earths ore. To go through all that planning, to then go through funding, build the plant, and then to suffer what has been, I guess, you can only conclude, some very heavy politicking and activism, where heavy allegations were made about radioactive byproduct coming out of the plant and how it was not in Malaysia's interest to have that plant. So there were political recriminations. The New York Times did a decent hatchet job on the supposedly shoddy construction standards of the plant, and it was quite a beat up at the time. The crescendo with the Malaysian situation was, I mean, no matter that they invested a substantial amount of money in the Malaysian economy and provided a large number of jobs, and it was probably the first major mining project or processing project to actually have occurred. It was a win for the government. They ran foul of I guess, minority groups and activist groups who essentially championed and brutalised the business into essentially having to close their production plant ahead of a major review into the worthiness and safety of having that plant in Malaysia. And of course, that brought about that activity brought about the demise of Lioness's share price, and seemingly a demise to their business model, which was built heavily around mining the ore in WA and then exporting it to Malaysia. It was a truly unfortunate set of circumstances they found themselves under.
And so they've raised a significant chunk of capital recently, and money that's going to go towards CapEx in Malaysia, but also the Kalgoorlie processing facilities. Just explain how those two facilities will interact with each other. Yeah,
that's a very fair question, because it would appear that they've spent all this money in Malaysia and now they've got to go and do the same thing somewhere else. I think you should look at it, and viewers should look at it as the Kalgoorlie plant, which, by the way, is fully permitted and approved and essentially funded now, will complement what's going on in Malaysia, and essentially to appease the Malaysians and to allow for their permit. And they're operating on like a 3-year permit. So all that money invested, Chris, you'd think you'd have certainty of production, but unfortunately it's now a series of permit renewals to keep the story going. we're going to see them essentially build a plant in Kalgoorlie, which will crack and leach the product and turn it into a carbonate, which will then be exported to Malaysia without any radioactive elements that Malaysia's been most fearful of, and then further refine the product in Malaysia. So Malaysia will actually complement what we're doing here in Australia. And furthermore, the Kalgoorlie operation will enable production for Lioness to expand from its current 20,000 tonnes or so annual production closer to 30,000 tonnes. So you'll see an expansion in production. You'll see a stable, safe, predictable production base in Australia where they can conduct the critical cracking and leaching operations. And then the product will go to Malaysia. So a good chunk of the coin that was raised in August is going, as you suggest, to building out this plant outside of Kalgoorlie. They'll be spending about 100 million US round numbers in tweaking and upgrading the Malaysian facility. And they've also earmarked a chunk of coin in that raising for the strategic partnership that they're working up with Blue Line in the United States, which I guess not a huge amount of information is known about the status of that JV, only that it will be a heavy rare earths separation facility, which will have industrial and military applications for the US Department of Defense. So that is a growth avenue for the product and for Lioness and its partner that really, we don't know how big or where that goes, especially given the fact that it'll be high-grade military and industrial applications. So that's where the money's gone, Chris. They raised it in August. We participated. We're a good-sized shareholder, as you hopefully have gathered by now. So they've raised the money through that transaction, and that positions them quite nicely with their credit facilities to get on with it and to build. Now they're up against a bit of a clock here because the Malaysian permit that they've currently got will expire in the first quarter of 2023. They'll need the Kalgoorlie operation to be up and running and fully commissioned by end of 22 to make sure that there's no mishaps there. And that's probably where there's a little bit of risk, I guess. The plant will be slightly different to the one in Malaysia, and they've got to build this plant on time and on budget down here. So there'll be the usual issues with building and commissioning a new plant. So not without risk this. It does seem to fit quite nicely. The permit expires there. The construction timeline suggests they've got to be finished by 22. So not without risks there. But I'm happy to back them, having already built a plant. I'm happy to back Amanda and her technical team.
In an era where jobs have become so important, it does seem strange that so many Australian mining companies traditionally dug stuff out of the ground and sent it overseas for processing. Could you see an emerging trend where the Australian government look to support mining companies even more so that processing's done onshore, creating jobs and creating more value for a mine product?
But almost inevitably, Chris, I would suggest that value-adding sequence will be foremost in the minds of company CEOs. Certainly Andrew Liveris and his group that are trying to work out how Australia can better manufacture and be smarter about keeping manufacturing here or value-adding in this country. There's no doubt that will be an active consideration for companies. Clearly, there are obstacles to that. There's invariably a big price to play, as the cost of setting up manufacturing facilities or mining, refining, and smelting facilities is not cheap.
Is power prices here the other big one that's a bit of a handicap when compared to overseas?
Correct. So power prices now, perhaps we're addressing that with domestic gas prices perhaps peaking and talking about importing of LNG and perhaps some of our crucial export markets for LNG perhaps won't be as robust as they were. So we'll see, I think, a greater amount of DOM gas available for local industry. So perhaps power and energy, electricity may not be as critical a factor, but certainly it's no doubt it's front of mind. So we may well see more examples of production like Lioness is doing, homegrown production. There's also, of course, there is Mining processing often tends to have an environmental side too, which may not resonate too well with the masses. But I think with technology being as it is, processing of almost any product is becoming safer, cheaper, and cleaner with technology. So I think to answer your question, I think no doubt we'll see more onshoring of processing and refining.
And so in terms of Lioness, just give me some of the headline numbers in terms of, say, market cap and what your free cash flow forecasts are for the next, say, 12 to 24 months.
Okay, so Lioness is capped today in today's money at around $3 billion. So it's got a reasonable market cap, reasonable valuation around it. If you look at what we think they're going to achieve when they fully commission Kalgoorlie with the expanded production base, we think you could argue that you could see some sort of EBITDA numbers for Lioness somewhere in the order of sort of 450 to 500 million. That's a pretty decent number.
Is that, sorry, Ben, to interrupt, is that assuming the commodity price stays where it is now? Is that assuming some commodity price growth?
I'd be assuming in that number, I'm assuming a little bit of growth there. At the moment, rare NdPr prices are circa $35 a kilo. I think the assumption around the number I talked to is sort of closer to a sort of $50 price.
Yep.
And I did see some work which was fascinating, Chris, just as a slight segue to your question, some fascinating work on the demand-supply interplay and how that's going to change with the rise of renewable energy applications and EVs. It's around 2023, there's an inflection point where demand accelerates quite rapidly. Now, you might say almost quite conveniently for Lioness that happen to have a supply coming on at that time. But it's interesting how the market goes into deficit at that point as EV and renewable energy goes from being 10% of demand to closer to 35 to 40% of demand. So you'll start to see a bit of a pinch come on there, again, because Lioness will be the predominant non-Chinese supplier. So we expect, and assuming that $450 to $500 million EBITDA number, that you'll see prices, a more sensible long-term prices around $50. So you'll see very, very handsome EBITDA numbers coming out of the business at that point in time, which means, which by definition suggests that cash flow will be very, very strong for the business at that point.
And so that's sort of a multiple of EBITDA looks attractive in and of itself. When you're viewing a business like Lioness, are you viewing it on an EBITDA multiple, or are you thinking about it in terms of its strategic importance, considering its materials are used for weapons? And in a way, if you control rare earths, you control manufacturing of lots of products and in effect jobs for people living in your country.
Yeah, that's right. Look, we certainly have an eye to it in terms of its EBITDA multiple valuation. You see some of the leading lithium producers out there, Albemarle and the like, on sort of 14 times EBITDA. It's not too cheeky to put Lioness on, say, 10 times EBITDA for its product, and as to your point, its strategic nature. So that gets you a valuation around $5 billion for the business versus, again, the current market cap around $3 billion. The other thing that we look at is, and it's an important part of our process, is what are the qualitative features of the business that set it aside? What are its redeeming qualitative inputs and features? And there's a great research note that Canaccord put out, and it was entitled, it was an initiation piece on Lioness, and it said strategic player in a critical market. And that, to me, really, in a couple of words, sums up the investment thesis for Lioness. It is a strategic player within a critical market. The US government in 2018 put rare earths on its critical metals inventory. So clearly the Americans are going to have a great interest in knowing where the non-Chinese supply of this product is going to come from, which of course is Lioness. So the strategic value, I think you can't move too far away from it. And that has, in our process, when we look to score a stock, we look at the qualitative features. We start looking at, we start, of course, with board and management. And we look at the stability and the maturity of the Lioness board. And you can't go too far away from Amanda Lacaze, who's an outstanding CEO, and we score her and rate her very highly in terms of her execution and her competency and her vision. but it's the industry fundamentals. It's the growth rate of this industry. It's the structure of the rare earths market that in our scoring process gives Lioness an extraordinary qualitative score. And that alone can almost underwrite an investment in Lioness. You have a process that looks at valuation and a process that considers qualitative features. And in many cases, both sides of the coin add up and you get an extraordinary stock weighting. In this case, Lioness is probably slightly more skewed to its qualitative assessment and scores very, very strongly in its qualitative view. So, Chris, very long-winded answer. I appreciate it, but there's valuation support if you're happy to start the gauge from about 2022, 23, and there's overwhelming qualitative and strategic benefits and I think attributes that make Lioness very interesting.
And we know that Westfarmers has already tried to take them over once. Do you think there's a chance they'll be back? And if not, who else could be a potential owner of Lioness?
That's a fair question. I guess Westfarmers, they swept on Lioness when it's on its knees. It was at a very vulnerable point in its history. I mentioned the closure of the plant in Malaysia, the share price reaction down to 32 cents. Westfarmers are patient, long-term, informed investors. They don't do anything in a hurry, and they tend to lay their bets for the long term. We saw that as an extraordinary endorsement as to the long-term strategic nature of Lioness, rare earths role in metalliferous demand globally. So I think Westfarmers were probably in the end too clever by half. They attempted to step in when there was some instability around the tenure of Lioness's plant and their ability and the confidence that the Malaysian people had in their ability to operate the plant going forward. So I think it was a great endorsement that Westfarmers stepped up. They bid $2.25 today. The stock price is about $3.30. So the stock has well and truly gotten away from them. I have no doubt that Westfarmers have got the folder somewhere there with all the work and the investment thesis. I just suspect the share price has gotten away from them. They perhaps would have done something before now. In terms of others looking at Lioness, I would suspect that Lioness would be something that's obvious to people, but I think the very strategic nature of this company and its assets mean that there's probably going to be more than the usual amount of interest from regulators, FIRB, the Americans, and of course the Japanese. And we haven't even talked about the Japanese, who are perhaps the biggest consumers outside the Chinese of rare earths, and they are incredibly loyal and supportive of Lioness, and in fact are providing funding. So I would be surprised if there's not a sort of a political or a regulatory overlay that makes it perhaps difficult, but not impossible for someone to take control of Lioness. That's just me hypothesising. I don't know. I know that there was some Chinese interest in Lioness going back in 2010, and the FIRB were very quick to shut that down. So I think the strategic value of the business is well known, and the ability of Lioness to end up in the wrong hands or other hands is perhaps going to be a little difficult. But that may not stop people trying, and it may not stop speculators from speculating on that.
Brilliant. It's been terrific, Ben. Outstanding as always. Really appreciate it, and you make a very compelling case for Lioness. Thanks again.
Thanks, Chris. Nice to see you.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.